What is enterprise value? Enterprise value or firm value is the sum of all ownership interests in a company and claims on its assets from both debt and equity holders. As seen in this formula here, it is defined as equity value plus total debt plus preferred stock plus non-controlling interest less cash and cash equivalents. The equity value component is calculated on a fully diluted basis. Theoretically, enterprise value is considered independent of capital structure, which is the debt and equity mix of a company used to finance its operations. This means that changes in a company's capital structure do not affect its enterprise value. Let's go through an example where a company issued new debt and how does that affect enterprise value. Here, we have a company with an enterprise value of 950 million. This is derived by adding up equity value of 800 million with 100 million debt, 50 million of preferred shares, 10 million of non-controlling interest, less 10 million in cash. Let's assume a scenario where a company raises additional 200 million in debt that is held on the balance sheet as 200 million cash. You can see that the increase in 200 million in debt is offset by the increase in 200 million in cash. Hence, the company's enterprise value remains constant at 950 million. What about a scenario where a company issues equity and uses the proceeds to repay debt? Here, we have the same company at an enterprise value of 950 million. Let's assume a scenario where a company raises additional 100 million in equity to repay 100 million in debt. You can see that the issuance of 100 million in equity increases equity value but is later offset by the reduction in 100 million in debt. Hence, the company's enterprise value remains constant at 950 million. In both examples, enterprise value remains constant despite a change in the company's capital structure. Hence, similar companies would be expected to have consistent enterprise value multiples despite differences in capital structure. One notable exception concerns highly leveraged companies, which may trade at a discount relative to their peers due to the perceived higher risk of financial distress and potential constraints to growth.